Música, por favor.
Sin más dilación, yo le pediría a Tom Zacharias, yo sí quería decir que además de su formación, que nos ha expuesto muy bien la presentadora, es un miembro de la Junta Directiva de la Asociación Internacional de Aseguradores de la Producción Agropecuaria, es decir, AIAG, como yo mismo, y es además uno de los 3 vicepresidentes de esta asociación. Es un hombre con un conocimiento muy grande, lleva en la NCIS de Estados Unidos desde el año 90, es decir, 35 años, y es autor de numerosísimos artículos publicados en los medios especializados más importantes sobre el seguro agrícola. Thank you very much for your availability, Tom, and the floor is yours.
Okay, thank you very much, Ignacio. Much appreciation. Good morning to everyone. I appreciate the opportunity to speak to the Alasa Congress. I realize that putting on these types of events requires much attention to detail and a lot of hard work, so I would suggest that we have a great deal of appreciation for the Alasa team putting this together, and Ignacio, you as well, for your efforts both on the scene and behind the scenes for this opportunity. Again, much appreciation for that. What I'd like to do here today is walk through the U.S. experience in crop insurance at a very high level, but provide background on sort of how we came to be where we are today in the U.S. crop insurance program. We'll start with the litany or chronology of legislative acts that have led to where we are today. First, let's start with the enabling legislation, the 1938 Crop Insurance Act, which established Federal Crop Insurance Corporation. I've included the purpose of the crop insurance program and refer you to that, where the notion behind this was to improve the welfare and the economic stability of agriculture through a sound system of crop insurance and the research and development that establishes that. Again, the act was signed in 1938, and essentially crop insurance in the U.S. on the federal side was somewhat dormant. It's important to be aware, though, that there was an active crop hail industry already active. Some of the companies that I work for at NCIS, they have history spanning over 100 years. So there was an active crop hail market going on at this time. This leads up to the 1980 Act, and the idea was that because participation in the U.S. for the federal program was low, could we involve the private sector and enhance sales and participation? So in the 1980s, the 1980 Act, that's really where the ball gets started with the public-private partnership. So we roll on to 1994, and at that time there was, in 1993, there was severe flooding and excess moisture, primarily throughout the Midwest United States. This resulted in a disaster program that was enacted, but following that up, the thinking was, can the monies and the effort that was put into a disaster program on an ad hoc basis, a response to a crisis, could that be converted into an annualized crop insurance program, which is where we ended up with the 1994 Act establishing a very high deductible or low coverage level of crop insurance at 50%. And at that time, requirement to buy crop insurance was linked to other benefits with the Department of Agriculture, other farm program benefits. Subsequently, that has been dropped, and now in the U.S., voluntary linkage is not required, and the participation is voluntary. Okay, so in between 1994 and 2000, the private sector brought to the U.S. government, brought to USDA, the idea of revenue products in the late 90s, mid 90s. This really changed the game for the Midwest. These revenue products were tied to active futures markets, particularly for corn and soybeans. We saw an uptick in participation. Then leading up to the 2000 ARPA Act to further increase affordability and availability, premium support was increased. And this too really got the program, very much up and rolling. 2008, sort of fine tuning. Between 2008 and 2014, the U.S. experienced a major drought in the Midwest, the 2012 drought. As a result of that, a particular thing, an anecdotal, I'll give you an anecdote of what happened. The Undersecretary of Agriculture went out to visit the Midwest and inspect the farm fields, and he had his card with him. And what he would do is ask the farmers, if you had a problem with federal crop insurance, would you please give me a call? And to date, to our knowledge, no one ever called the undersecretary. So the servicing of the business during that massive drought was a critical success factor for the crop insurance program, the private industry in particular, which leads to the 2014 Act, where it's safe to say at this stage, 2014 Act and 2018, these became where crop insurance is routinely referred to as the cornerstone of the farm safety net in U.S. farm policy. Next slide. There we go. Okay. All right. So to me, federal crop insurance in particular represents an economic and a political partnership. And with that, there are two components, two attributes, particularly of what we enjoy in the U.S., that maintain this structure and allow for the growth and the stability that we've observed. One is crop insurance is a rules contract-based system. Policies on the part of the farmer, we'll talk about this in a minute. And then the role of both public and private cost sharing. And I'll go into these each individually in some degree. All right. First of all, the Federal Crop Insurance Act that we've referred to established the Federal Crop Insurance Corporation, and this is the overriding legislation. Between the federal government and the insurance companies that I work for that write this business, there's something known as the Standard Reinsurance Agreement, and that is the basis for the relationship between the federal government and the private sector. Talk a little bit more about that later. One row down from that is the relationship between the farmer and the insurance company as designed and defined by the crop insurance policy. And then lastly, or alongside of, is the relationship between the crop insurance agent and the crop insurance company. At each stage in the process, this is defined by policy language, contractual language, etc. Also not included in the slide is the relationship between the insurance company and the reinsurance companies in the market. So all throughout the system, this is contract and rules-based. Very important for the success. In addition, all program participants have an economic and financial stake in the business. Farmers, through their deductibles and premium costs, that is their form of cost sharing. The deductibles in the U.S. are in the range of 25 to 30%, meaning that coverage level on a national scale is about 65, well, more like 70 to 75% coverage. Again, that's nationwide. Premium costs, farmers paying out of their own pocket for federal crop insurance, that can run up to $6 billion or in excess thereof, depending on the commodity price regime. If you have high prices, premium costs are naturally more. But the last several years, $6 billion is not a bad estimate. Taxpayers also share in the cost of this program. In the event, for example, in 2012, where there's extreme losses, government will pick up part of the risk sharing. They also provide support for premium for farmers. And then also there's an expense component that is allocated to the private companies to service the business. So the taxpayers also are invested. The insurance companies, they provide the infrastructural support, agents and adjusters, risk sharing on the part of the insurance companies. They too have a stake in the game. The crop insurance agents themselves provide a rural infrastructure and a rural presence, working with the farmers to meet their risk management needs, and the reinsurance companies also on part of the risk through the risk sharing agreements. And these, it's important to also make the case that the cost sharing and the contractual structure, these are self-reinforcing, okay? In other words, the reinsurance agreement tries to incentivize the behavior of the AIPs, the deductibles, premium costs. Farmers have their stake in the success of the program. So this is tied together between the cost sharing and the contractual basis. I've mentioned the standard reinsurance agreement a few times already. We won't go through this line by line, but basically this is the fundamental agreement between the private sector and the federal government. This is actually a public document. You can go out on the internet, access this document, read it yourself. Each company signs the same agreement, hence the term standard, all right? So this is, in a sense, a very public-facing aspect of the program. In the standard reinsurance agreement, data reporting requirements, all the responsibilities and the obligations of the companies are defined here. Much interest is how the risk is shared between the private sector and the federal government. We won't go into this in detail because there's a lot of detail here. But basically, at a very high level, risk is divided by a region or an individual state in the U.S. and two different types of funds, a commercial or a risk fund, more opportunities for profit taking or the ability to make a profit in the commercial fund, and where some business is not as profitable, etc. There's an assigned risk. So there's considerations made for the different types of risks that you face in the U.S. The idea, again, is to incentivize the insurers for taking on proper risk at the same time, in the event of extreme losses, protecting their investment. We back up just a little bit. There's both federal and state regulation in the U.S. crop insurance market. There's essentially two lines of insurance: federal crop, which we're speaking mainly about today, but also companies write crop hail business and other associated perils. That component of the business is regulated by the individual states of Iowa, Minnesota, Idaho, you name it, each 50 state, right? The benefit of regulation is, and the purpose of regulation is to prevent fraud, waste, and abuse. And the design is to protect both the farmers, the taxpayers, and the shareholders in the system. One can debate if there's too much or too little regulation, but the importance of it is that it's there at two levels, and the intent is to improve the overall program for the benefit of all shareholders. Okay, program structure. Who does what? And it's important, again, to make this distinction between federal crop insurance and state-regulated business. All right? The regulator, in the case of feds, is the risk management agency. That's who the companies primarily deal with. The premiums, risk sharing, cost support, there's federal support for that. Premium rates in federal crop insurance are set by the USDA, the risk management agency. And the perils are basically multi-peril crop insurance, as it's commonly referred to, yield losses, revenue losses, and the nature of how losses are determined are on a field or on a hectare basis, which is somewhat different than state-regulated business. All right, for state-regulated crop insurance, there is no premium support by the individual states. Companies expense load these premiums, charge those to the individual farmer. Premium rates are set by the individual companies. The perils are primarily hail and wind, and this coverage is adjusted on a spot or specific area of loss basis. So there is a distinction between the two types of insurance. Okay. Who does what in the U.S. partnership? For the private sector, the folks that we work for, there are currently 12 approved companies approved by the federal government. The workforce is approximately 20,000 agents, adjusters, and company staff at the various offices. In the government, there's approximately 400 staff members working with USDA and RMA. Both parties may design and develop products and bring products to market. The sales and service is the purview of the private sector. In terms of collecting premiums, that's the job of the private sector. The government's role is to set the premiums, and as we mentioned earlier, the various levels of cost support. Underwriting, both parties bear risk in the U.S. system. When it comes to claims, claims are paid exclusively by the private sector, and the turnaround on this is about 30 days. This is a feature that is very attractive and one of the success stories of the crop insurance program. If you look at a year like 2012, these indemnities, losses were adjusted, say, in August, September, October. Most of this was paid out by the end of the year, which for 2012, I believe, was about $17 billion. So the system has the capability of processing a great deal of claims, a high volume of dollars, fairly expeditiously. Quality control set forth in the SRA are the rules being obeyed. That's the role of the companies. The government has oversight for that. I'll skip the education and move on to the next slide, although that's important. Don't get me wrong. All right. Because we're covering this pretty fast, I think it was important to provide a diagram or a schematic of actually how the money flows in the crop insurance system. And we'll start, this is sort of chicken and the egg. We'll start with the RMA. Basically, they do provide support to the farmers up in that upper left-hand quadrant. That is a non-cash transaction, but it is scored for purposes of the federal budget. So that's the premium support this year is 2024, excluding livestock. Gives you an idea of the level of premium support to the farmers. Farmers themselves, as I mentioned earlier, they will pay $6 billion into the system. That money is processed by RMA, if you start at the top of the triangle again, and based on the premiums amounts, the underwriting gain, the difference between profit and loss, that is run through the provisions of the standard reinsurance agreement. Those payments are made to the companies along with the administrative and operating payment. Okay, and these are estimates on that side. Ultimately, these numbers all become public, and you can look at on government websites and basically verify these quantities. The indemnities are paid from the government to the delivery system, and then based on the number of losses, amount, etc., then that goes back to the producer. So that's basically how the money flows in the federal crop insurance program. All right, winding down. There is the USDA website, the Risk Management Agency website contains much information on the details of the program. How much insurance by crop, the land area, the dollar amounts, the different types of coverages. So I'm not going to go into that there. That's fairly easily accessible if you want. But at a very high level, for federal crop insurance, about 539 million acres or 218 hectares, if we got our conversion right, I hope. In terms of total liability for U.S. crop for 2024, approximately 190 billion. And then within that, the majority of this is field crop. But there are area and index plans that represent for 2023 about 10% of the liability. Specialty crops, about 14%. And each of these last two categories have grown considerably. With respect to index plans, within the last 3 to 4 years, a hurricane tropical storm product was introduced. And in 2024, it's triggered off weather data provided by the National Weather Service, NOAA, and there was approximately just under $1 billion paid out in about 4 weeks using this index plan. So we are seeing the development evolution of the integration of individual plans with area and index plans over time. In summary, as stated numerous occasions in this talk, federal crop insurance represents the cornerstone of the U.S. foreign policy safety net. We enjoy both broad farmer and political support, and that, in my estimation, is due to the commitment of both the private sector and the public sector to make this program work. And for these public-private partnerships to be effective, that becomes fundamental, as we've stated throughout. Both financially and politically, both sectors have to roll up their sleeves and determine that this is how a country entity wishes to manage risk at the national level. And with that, I very much appreciate your attention, the opportunity to address the Congress. Hope you have a successful and productive meeting. And with that, I will conclude my remarks.
Thank you so much, Tom, for intervention. First of all, I would like to add to his presentation that the National Crop Insurance Services, which is what the organization he is chairing, is the only organization representing all the insurance companies underwriting crop insurance in the United States, as much in the federal program as in the state regulated programs. Once said that, I would suggest to make questions to the virtual participants immediately after their speech in order for them to be able to give up connection if that is their desire. I myself would have a couple of questions for Mr. Zacharias. One of them is, Tom, according to what you've said, the FCIC is acting as the reinsurer of the system as well as the subsidies provider. I would like to ask to you, is there any kind of participation of other reinsurers other than the FCIC in the national crop insurance system? I mean, private reinsurers?
Yes, there is a private reinsurance market that both underwrites federal crop insurance with the individual companies as well as the state-regulated crop hail business. So yeah, there's active participation by both domestic and international reinsurers in the crop insurance program.
And the results, the historical results of the reinsurers are reasonably balanced along the years?
Yeah, the program itself has pretty much been on its actuarial target for, say, the past 10 to 15 years or so, due to a number of factors of improved underwriting, better understanding of the risks. The last few years have been a little more volatile with some weather conditions, but the results have been stable enough that the market has been robust with respect to reinsurance and company participation.
Okay, and the last question on my side. What are the most relevant challenges and opportunities for national crop insurance program in the States at present and in the short future?
Well, that's a good question. I would say there's a few headwinds these days, to be honest. First, if we look at the map of the United States, the drought monitor, there are several wide swaths of the country that are facing moderate drought right now, although we're getting rainfall in some areas. Actually, we're having some flooding in sort of the southern central part of the U.S. So the risks that we face as insurers, those are upon us as we come into planting time. The farm economy is facing some uncertainty, lower commodity prices, higher input costs. Input costs have been sticky somewhat since the pandemic and with the inflation that we've observed. Also, there's no getting around the trade uncertainty. that we're facing these days. Also in the U.S., a new political administration, so those administrators are being appointed as we speak. We know the Secretary of Agriculture, that has been announced, but there are a series of administrators or administrators below the Secretary, and those positions are being announced. So to meet those folks and find out, what the actual goals that affect the companies, that's going to be an ongoing process. And then the opportunity out of all this is, because we have enjoyed such success over time, is to maintain the level of support, keep providing the service that's been provided, and making sure that the farmers and ranchers of the country, their risk management needs are met. So we have a full plate. There's no doubt about it.
Okay, then summarizing the same problems as anybody else.
Okay.
I would suggest no more questions because we run out of time. I'm sorry. And I've been particularly insistent on this point. So, Tom, thank you very much for your availability again, and see you soon in the board of the AIG. Thank you.
Thank you, Ignacio. Thank you, everyone.